warm morning to our beloved lecturer Puan Noriza and my fellow friends. My name is Vasundra Chandran and my group members' name is Nurul Ain, Nur Anisha and Nishwarna. We all are from DAT Satusi. Today we are here to present about accounting for trade payables, provision and contingent liabilities and also contingent asset.
Assalamualaikum to my friend and my lovely madam. My name is Nuranisha binti Zaini. Will present about trade payable. Trade payable constitute the money a company owns its vendor for inventory related goods, such as business supply or material that are part of the inventory. Accounts payable include all of the company short-term debt or obligation. An example you can see in this slide. I have another example to want to share with my friend is if the Dutch Lady company is adapted to the company box factory for packaging, the goods are part of the inventory and thus part of its trading business.
I will continue the presentation about trade payable are classified as current liability when number 1, it is a present obligation, number 2, it is a result of past transaction or other past events, number 3, it is classified as cash or a cash equivalent unless the assets are restricted from being exchanged or used to settle a liability for at least after 12 months, which is after the reporting period. For example, SBD Berhad purchased goods on credit from Achong and promised to settle the credit on the 28th after the purchase. The solution for this example is there will be a payment of cash to Achong on the 28th after purchase. The amount owed is a trade payable which is classified as a current liability in the financial statement. There will be an obligation to pay cash or settle the credit on the 28th after the purchase. Achong as another party has a contractual right to receive the cash from the entity.
See me back again, and this one I will talk about provision and contingent liabilities asset with example. Okay, the first one is a contingent liability is an expense that may be incurred depending upon the outcome of a future event. For example, a lawsuit filed against a company could create a contingent liability if the amount being pursued by the counterparty is material. The second one is a contingent asset is one whose value depends on the outcome of a future event. In the example, for contingent liability above, the company filing the lawsuit may record a contingent asset on its books, pending the outcome of the obligation. What is the meaning of provision is accounting? Okay, provision represent fund put aside by a company to cover anticipated loss in the future. In other words, provision is a liability of uncertain timing and amount. Provisions are listed on a company balance sheet. These statements are key to the both financial modeling and accounting under the liability section.
Next, I will explain about comparison between provision and payables. We'll go first for payables. Payables are liabilities to pay for assets, goods, or services that have been agreed to with the supplier. Therefore, the timing and the amount of the payment to be made are certain. Besides that, provisions are liabilities that have certainty in terms of timing or amount of purchase. Examples of provision include provisions for litigation, risk warranties or product guarantees and refunds. The seller has an obligation to honor the warranty and refund the customer.
Now, I want to present about contingent liabilities. Definition of a contingent liability is A possible obligation that arises from past event and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. Other than that, a present obligation that arises from past events but is not recognized because uh, it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, or the second one is the amount of the obligation cannot be measured with sufficient reliability. This is according to MFRS 137. Example of contingent liabilities include a lawsuit in which it is possible that an entity will lose and a guarantee related to collectability of a trade receivable. Another example for this is Kamal initiated a legal proceedings claiming damages of Rm 1 million against Berjaya Berhad for misleading advertisement. At the reporting date, the lawyers of the entity were of the opinion that there was a possibility that the entity would lose the case. Since the obligation is possible, the entity has no present obligation that arises from past event. Therefore, it cannot be classified as a liability. Instead, it is classified as a contingent liability because the entity should disclose the nature of the contingent liability, the estimate of its financial effect, for example, Rm 1 million, an indication of uncertainties relating to the amount of timing of any outflow and the possibility of any reimbursement if practicable. Now I want to present about contingent assets. Definition of contingent asset is a contingent asset is a possible asset that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrences of one or more uncertain future events not wholly within the control of the entity. Example of contingent asset include a claim that an entity is pursuing through legal processes where the outcome is uncertain, possible refunds from the governments in tax disputes, and possible receipts of monies from donations, bonuses, or gifts. For example, Sri Himchan Berhad is taking legal action against company EWRS for failing to deliver on contracts for its product. The lawsuit is in the final appeal. The legal advice is that is it probable that they will win the case and will be awarded Rm 600,000. A contingent asset cannot be recognized as asset even though the gain is probable and reliably estimated. The contingent asset should only be recognized when it is certain or virtually certain. It is disclosed, but care should be taken to avoid misleading information regarding the likelihood of the gain.
Hi, good morning to my friend and madam. Now I will continue the presentation. The company we selected to present is Dutch Lady. The slide now showing is statements of financial position as at 31 December 2020. Now I will elaborate about the provision. Provisions are recognized when the company has a present legal or constructive obligation as a result of past events, it is probable that an outflow of resources will be required to settle the obligation, and a reliable estimate of the amount can be made. Where the company expects a provision to be reimbursed by another party, the reimbursement is recognized as a separate asset, but only when the reimbursement is virtually certain. Provisions are not recognized for future operating losses. Where there are a number of similar obligations, the likelihood that an outflow will be required in settlement is determined by considering the class of obligations. As a whole, a provision is recognized even if the likelihood of an outflow with respect to any one item included in the same class of obligation may be small. Provisions are measured at the present value of management. Best estimate of the expenditure expected to be required to settle the obligation using a pre-tax rate that reflects current market assessments of the time value of money and the risk specific to the obligation. The increase in the provision due to passage of time is recognized as financial cost expenses. Provision for employees' pensions contribution reflects provisions made for additional contributions to be made to the statutory employees' provident fund that will vest upon union staff having completed 5 years of service. The provision has been made on the assumptions that all relevant staff will complete their 5-year term, and that therefore their benefits will vest in its entirety.